Unit 8. Financing Real Estate. Learning Objectives. When you have completed this unit, you will be able to understand the concept of leverage and its role in most real estate purchases. A. Explain how the various federal agencies help regulate the cost and availability of credit. A. Identify the documents used in the purchase and financing of real estate. A. Describe the impact of California's anti-deficiency protection for homeowners. A. Explain the foreclosure process under a mortgage and deed of trust, and how they differ. A. Identify the lenders who are part of the primary mortgage market. A. Define common mortgage plans. And A. Explain California's restrictions on mortgage brokers and state and federal disclosure requirements. Key terms: acceleration clause, adjustable rate mortgage, ARM, adjustable rate note, alienation or due on sale clause. American Recovery and Reinvestment Act of 2009. ARA, amortized loan, annual percentage rate, APR, assumption, balloon payment, basis point, beneficiary, California finance lender, California finance lenders law, California Residential Mortgage Lending Act, certificate of discharge, construction loan, credit bid, declaration of default, deed of reconveyance, deficiency judgment, Department of Housing and Urban Development, HUD, discount rate, Equal Credit Opportunity Act, Fair and Accurate Credit Transactions Act of 2003, FCTA, Fair Credit Reporting Act, FCRA, Federal Funds Rate, Federal Housing Finance Agency, FHFA, Federal Reserve Bank System, the Fed, FICO Score, Financial Institutions Reform, Recovery, and Enforcement Act of 1989, FIRA, Fixed Rate Mortgage, Graduated Payment Adjustable Rate Mortgage, GPAM, Graduated Payment Mortgage, GPM, Growing Equity Mortgage, GEM, Holder in Due Course, Home Affordable Refinance Program, HARP, Home Equity Sales Contract, Home Loan Toolkit, Hypothecation, Impound Account, Installment Note, Institutional Lenders, Interest Rate, Interim Loan, Joint and Several Liability, Judicial Foreclosure, Junior Lender, Kickback, Leverage, Loan-to-Value Ratio, Lock-in Clause, Mortgage Bankers, Mortgagee, Mortgager, Negative Amortization, Negotiable Instrument, Nominal Rate, Non-amortized, Notice of Default, Notice of Trustee's Sale, Open-ended Mortgage, Pledged, Points, Power of Sale Clause, Prime Rate, Principal, Private Mortgage Insurance, PMI, Promissory Note, Real Estate Settlement Procedures Act, RESPA, Real Property Loan Law, Redemption Period, Regulation Z, Reinstatement, Renegotiable Rate Mortgage, RRM, Reverse Annuity Mortgage, RAM, Right of Redemption, Right to Rescind, Satisfaction, Secure and Fair Enforcement for Mortgage Licensing Act, SAFE Act, Security Instrument, Shared Appreciation Mortgage, SAM, Standby Commitment, Standby Fee, Straight Note, Subject to, Takeout Loan, TILA RESPA Integrated Disclosure, Trade, Trustee, Trustee's Sale, Truster, Truth in Lending Act, TILA, Uniform Residential Loan Application, Unlawful Detainer, UNRU Civil Rights Act. Usury, Summary. Buyers use the leverage afforded by credit to finance the purchase of all forms of real estate. The availability of loan funds is influenced by the cyclical nature of our economy and regulated by the Federal Reserve Board. The Office of Thrift Supervision, OTS, regulates the savings and loan industry. The Federal Housing Finance Agency, FHFA, oversees the federal home loan banks, which lend funds to member institutions. Recent legislation to promote recovery from the recent economic and housing downturn includes the Housing and Economic Recovery Act of 2008, HERA, and the American Recovery and Reinvestment Act of 2009, ARA. HERA includes the Secure and Fair Enforcement for Mortgage Licensing Act, SAFE Act, which requires reporting and recordation of those who make, arrange, or service loans secured by real property. California and federal laws impose special requirements on the residential mortgage loan originator, MLO. Usury laws prohibit the charging of exorbitant rates of interest. Proposition 2 and the Deregulation Act exempt from the usury laws loans secured by real estate and made by most lenders. Real estate financing is made possible by use of a promissory note in conjunction with a security instrument that hypothecates the real estate against which money is borrowed. Cosigners on a promissory note may have joint and several liability. A promissory note can be sold or transferred. If a promissory note meets their requirements for a negotiable instrument, a subsequent holder in due course can defeat most defenses to its enforcement. The deed of trust is the security instrument of choice in California, although the mortgage also may be used. Notice must be given in the event of the borrower's default. The judicial foreclosure of a mortgage is a longer process than a trustee's sale, and there is no right of redemption following a trustee's sale. A mortgage with a power of sale clause also will avoid a judicial foreclosure. The primary mortgage market consists of both institutional and non-institutional lenders. Institutional lenders include thrifts, commercial banks, mutual savings banks, credit unions, and insurance companies. Non-institutional lenders include mortgage companies and private individuals. Non-financial institutions, such as www.preventloanscams.org, California_E_principles_10E_book.inp 267 the 23rd of May 2017 2:30 and 31 seconds p.m. 268 California Real Estate Principles 10th edition. Colleges and universities, pension funds, and trusts also carry real estate loans, although not usually as part of the primary mortgage market. Mortgage brokers are subject to the real property loan law. They must complete and deliver a mortgage loan disclosure statement to borrowers for signature before the transaction is completed. The Truth in Lending Act, Regulation Z, imposes disclosure requirements on consumer credit transactions and restricts advertising of credit terms. The required disclosure statement includes all details of financing, including the annual percentage rate, APR, which may be much higher than the nominal rate. A consumer has the right to cancel a credit transaction involving a security interest in the consumer's principal dwelling within a 3-business-day period, or longer if the interest rate changes before closing. TRID requires a home loan toolkit and a loan estimate detailing estimated closing costs. A closing disclosure must be supplied no later than 3 business days before consummation of the loan. Some loans may be assumed or property may be sold subject to the loan. Acceleration or due on sale clauses are enforceable by lenders. Loan application policies must comply with the Equal Credit Opportunity Act and the Fair Credit Reporting Act, as well as state law. Open for discussion. When property values rose to dizzying heights in Japan, lenders began to make loans with up to 100-year terms. 1. Do you see such loans in California's future? 2. In what ways can lenders help keep loan costs down? California_E_principles_10E_book.inp 268 the 23rd of May 2017 2:30 and 31 seconds p.m. Unit 8 Financing Real Estate 269 Review Questions 1. A $450,000 house can be purchased with a $90,000 down payment using the principal of A. Borrowed funds. B. Leveraging. C. Partial financing. D. Home equity. 2. The Fed can increase or decrease the amount of money in circulation by all of the following except A. Establishing the discount rate. B. Issuing government securities. C. Raising or lowering reserve requirements. D. Buying and selling government securities. 3. Federal savings and loan activities are overseen by A. the FHLMC. B. the Office of the Comptroller of the Currency. C. the Federal Reserve Board. D. the FDIC. 4. California usury laws apply primarily to A. financial institutions. B. all lenders. C. non-financial institutions. D. private lenders. 5. Real estate is hypothecated by use of A. a promissory note. B. a negotiable instrument. C. a security instrument. D. a pledge. 6. To be a negotiable instrument, A promissory note must be a promise to pay money to the bearer. B. An oral agreement. C. Payable at an indefinite future time. D. Signed by the bearer. 7. A holder in due course must take a negotiable instrument A. within 90 days of its execution. B. With knowledge of all defenses against it. C. Without notice of any defense against its enforcement. D. For cash. 8. In a mortgage, the lender is A. the mortgager. B. the mortgagee. C. the maker. D. the holder. 9. The highest bidder at a judicial foreclosure receives a deed. B. a contract. C. a title. D. a certificate of sale. 10. In a deed of trust, the borrower is A. the truster. B. the trustee. C. the beneficiary. D. the holder. 11. In a deed of trust, the lender is A. the truster. B. the trustee. C. the beneficiary. D. the holder. 12. The first step in bringing about a trustee's sale is to prepare a declaration of default. B. a notice of levy. C. a request for notice. D. a notice of default. 13. There is no right of redemption following a strict foreclosure. B. a trustee's sale. C. a judicial foreclosure. D. a mortgage foreclosure. 14. An ARM is a graduated payment mortgage. B. a growing equity mortgage. C. a mortgage in which the interest rate changes periodically based on an index. D. a reverse annuity mortgage. California_E_principles_10E_book.in 269 the 23rd of May 2017 2:30 and 31 seconds p.m. 270 California Real Estate Principles 10th edition 15. Most adjustable rate loans are A. assumable. B. not assumable. C. held by sellers. D. not allowed for federal institutions. 16. Interest rate and payment can change every 3 to 5 years in A. a graduated payment mortgage. B. a renegotiable rate mortgage. C. a growing equity mortgage. D. a reverse annuity mortgage. 17. TRID applies to A. HELOCs. B. construction-only loans. C. loans made by a person who makes 5 or fewer mortgages in a calendar year. D. reverse mortgages. 18. RESPA covers A. the listing agreement. B. the broker's commission. C. the closing disclosure form. D. the loan application form. 19. David Lieu bought Whitaker and is making the former owner's original loan payments. If David defaults, the seller will be obligated on the loan. Which statement is true? A. David bought the loan. B. David bought the property subject to the loan. C. David is subject to a due on sale clause. D. David does not have title to Whitaker. 20. A lender that discriminates against a loan applicant because of race has violated A. the Equal Dignities Rule. B. the Truth in Lending Act. C. the Equal Credit Opportunity Act. D. the Lender's Law. Purposes of financing real estate. Affordable financing benefits both businesses and consumers. When funds are readily available for borrowing at reasonable terms, businesses can grow and prosper. For individuals, access to financing means the dream of home ownership can become a reality. Across the country, over $10 trillion in loans on 1 to 4 unit residences were held in 2016. It is easy to understand why a homeowner or an investor would want to own property. Real estate has tended to grow in value over the years because of its scarcity and desirability. Real estate values can still be volatile, however, as they reflect the general state of the economy as well as demand for a limited supply of properties. As reported by the California Association of Realtors, registered, the median price of a single-family detached home in California reached an all-time high of $594,530 in May 2007, before beginning a downturn to a low of $245,230 in February 2009, reflecting the nationwide recession. Home prices, aided by a growing economy and record low interest rates, have recovered dramatically since then. In the second quarter of 2016, the median California single-family detached home price was $516,220, with San Jose at $1,085,000. The first U.S. city to have a median existing single-family home price over $1 million. Often the greatest financial benefit of real estate ownership is that it can be used as security for a loan. By borrowing money against the value of the property, home purchasers benefit from present use and, unless property values are stagnant or declining, future appreciation, increase in value, and forced saving by paying down the amount owed. There may also be tax advantages, as discussed in Unit 11. Of course, the purchaser who relies on a loan to finance the purchase must have enough income to make the loan payments. But that income generally is far less than the cash that would be needed to buy most property outright. The purchaser thus uses the leverage of a relatively small initial cash outlay to finance purchase of a property worth many times that amount. By reducing the amount of cash that a buyer has at risk, a leveraged purchase can also help protect the buyer if market values go down. For example, the Sanchez's are buying a suburban house. The purchase price of $500,000 is being financed by the seller. The Sanchez's will pay $100,000 cash and make a payment of $2,308.95, which includes interest and part of the principal, the balance of the loan, each month. At the end of 30 years, the Sanchez's will own their home outright and will have no further loan payments to make. $500,000 house. $100,000 plus $2,308.95 per month for 30 years. Most home purchases would be impossible without the use of leverage. California_E_principles_10E_book.in 217 the 23rd of May 2017 2:29 and 5 seconds p.m. 2:18 California Real Estate Principles 10th edition. Some of the most valuable benefits of home ownership are realized when the property is sold, even if it is sold well before the end of the loan term. For example, the Sanchez's decide to sell their home after 12 years of ownership. The selling price is $880,000. By that time, they have paid down the principal of their $400,000 debt by approximately $70,000, but they incur expenses of $50,000 in commission and costs on the sale. So, they net $500,000 at the close of escrow. After paying themselves back the initial $100,000 they used for their down payment, they receive a profit of $400,000. Thus, the Sanchez's have leveraged $100,000 to make $400,000. The previous example is a very simplified one. Of course, it fails to take into account the year-to-year benefit of home ownership that the Sanchez's may realize thanks to the tax deductions their real estate ownership generates. They should also take into account the cost of renting comparable housing, which may be more or less than the cost of ownership, as well as the intangible value of being owners and not renters. Cost of credit. A purchaser of real estate who defers part or all of the purchase price uses some form of credit. When the purchaser receives credit from the seller, the cost of that credit is usually the interest rate charged to the purchaser. The purchaser may borrow money from another source to finance the purchase or borrow money using property already owned outright as collateral. In either case, the cost of those funds typically is expressed as interest. The cost of using money also may include loan fees or points paid at the time of closing, with 1 point equal to 1% of the amount borrowed. Note: when interest rates are quoted by regulatory agencies and financial institutions, they often are expressed as basis points. 1 basis point is 1/100 of 1%. So 25 basis points are the same as 0.25%. Just as there is a market for real estate, there also is a market for the money used to finance real estate. Lenders compete for borrowers by trying to make their loans as attractive as possible. They do so by lowering interest rates and making other loan terms, such as fees and time needed for processing, as attractive as possible. Most lenders rely on outside sources from which they receive the funds that they loan out to purchasers of real estate. If the supply of funds is diminished, or if funds become more expensive for lenders to acquire, the result will be higher interest rates and less favorable terms for borrowers. The money supply. Money is a medium of exchange as well as a measure of value. In exchange for our work efforts, we earn income in the form of money. Income also comes from the following: A. Investments. California_Principles_10E_book.in 218 the 23rd of May 2017 2:29 and 5 seconds p.m. Unit 8 Financing Real Estate 219. A. Rents. A. Royalties. A. Interest on amounts owed to us. We exchange our income for products and services, invest it, or save it. Income is taxed to provide funds for government to carry out the services it provides. Businesses also receive income and in turn make payments for taxes, salaries, and other costs of production, as well as investments. The production of income is cyclical. See Figure 8.1. As consumer demand for goods and services increases, the elements of production flourish. Figure 8.1. Economic cycles. Prices rise. Wages increase. More workers are hired. More money is available for purchases. Demand for goods and services increases. Prices decrease. Wages decrease. Some workers lose their jobs. Less money is available for purchases. Demand for goods and services decreases. The inflation cycle. The deflation cycle. Factories are built, products are made, and employees are paid. These activities, in turn, pump more money into the economy. The income diverted to taxes is used to buy the goods and services that support government programs. Taxes also subsidize individuals and businesses through a variety of direct and indirect payments. Investment funds and savings provide the capital needed for the industry to grow and prosper. Savings also form the basis of the funds loaned to purchasers and developers of real estate. Savers are paid interest by lending institutions, which in turn charge a higher rate of interest to borrowers of those savings. The federal government is actively involved in the financial marketplace for both commercial and residential loans. Federal Reserve Bank System. The Federal Reserve Bank System, the Fed, was created by Congress in 1913 to serve as the central bank of the United States. Information on the history of the Fed, as well as links to related sites, can be found at the website www.federalreserve.gov. www.federalreserve.gov. California_Principles_10E_book.in 219 the 23rd of May 2017 2:29 and 7 seconds p.m. 220 California Real Estate Principles 10th edition. The Fed regulates the flow of money and the cost of credit to help stabilize the market fluctuations that create inflation or recession. The 12 regional Federal Reserve banks follow the policies set by a 7-member board of governors. Members of the board are appointed by the President of the United States and confirmed by the Senate for 14-year terms. California, Alaska, Arizona, Hawaii, Idaho, Nevada, Oregon, Utah, and Washington are in the 12th Federal Reserve District, headquartered in San Francisco. The Fed makes its own decisions but reports to Congress, and its power can be revoked by Congress. The main activities of the Fed are accomplished by a raising or lowering reserve requirements, cash on hand, of member banks, which decreases or increases the amount of money allowed to circulate, a establishing the discount rate, interest rate, that member banks must pay to borrow money from the Fed, which affects the federal funds rate that member banks charge each other for borrowing funds they maintain with the Fed, the prime rate that banks charge their most favorably rated commercial borrowers, usually but not always 3% above the federal funds rate, and, ultimately, the rate consumers are charged, and a buying and selling government securities to affect the amount of funds available for savings and other investment, and thus the amount available for borrowing. Since 1980, even banks that are not members of the Fed have been required to comply with its reserve requirements. Federal Home Loan Banks. The Federal Home Loan Bank System, FHLB system, was authorized by Congress in 1932. There are 12 regional federal home loan banks and they are now regulated by the Federal Housing Finance Agency, FHFA. The Federal Home Loan Bank of San Francisco covers the 11th Federal Home Loan Bank District, which includes California, Nevada, and Arizona. Member institutions, such as federally or state-chartered savings and loan associations, must own capital stock in the regional federal home loan banks, which in turn lend money to member institutions. In 1989, commercial banks and federally insured credit unions became eligible for membership in the FHLB system. In 1999, Congress made membership in the FHLB system voluntary for all types of eligible institutions. By 2016, the FHLB system included 7,200 lenders. Federal Deposit Insurance Corporation. The Federal Deposit Insurance Corporation, FDIC, was created by Congress in 1933 to insure individual accounts in participating banks and, as of 1989, savings and loan associations, currently up to $250,000 per depositor, per insured bank, for each ownership category. Many other federal and state agencies and departments affect the availability and cost of credit. Some of them are discussed below, and others will be discussed in the next unit. Recent legislation has had far-reaching consequences. When the chairman of the Federal Reserve Board announces a change in the Fed's interest rate, the whole world pays attention. www.fa.gov California_E_principles_10E_book.in 220 the 23rd of May 2017 2:29 and 7 seconds p.m. Unit 8 Financing Real Estate 221 Legislation intended to place thrifts, savings and loan associations on equal footing with commercial banks had some unfortunate consequences, including their failure of many institutions. The Depository Institutions Deregulation and Monetary Control Act of 1980 began the process by greatly expanding the ability of depository institutions to offer services and yields competitive with market rates. The road to FIRA and the subprime lending crisis. With deregulation came many abuses by thrift associations that were poorly managed, improperly documented loans, inept or falsified property appraisals, and outright theft of association funds were some abuses that led to the downfall of many institutions. Congress attempted to overhaul the thrift industry by passing the Financial Institutions Reform, Recovery, and Enforcement Act of 1989, FIRA. FIRA established the Office of Thrift Supervision and the Federal Housing Finance Board to take over the savings and loan supervisory responsibilities that formerly had belonged to the Federal Home Loan Bank Board, FHLBB. The FDIC was given the additional responsibility of ensuring deposits in all federally chartered banks and savings institutions, as well as the bank deposits it already insured. Savings and loan deposits had previously been insured by the Federal Savings and Loan Insurance Corporation, FSLIC, which ceased operation. With one crisis under control, the seeds were sown for another. Continuing low interest rates and relatively easy access to funds inevitably led to the real estate market boom of the first years of the 21st century that also attracted investors who flocked to real estate as a safe haven from the stock market's booms and busts, particularly those involving the technology stocks. Wall Street played a role in their increasingly frenetic real estate market by creating securities based on the value of real estate used as collateral in increasingly risky loans. Many loans required little or no down payment, and borrowers were able to take advantage of no-doc loans in which the borrower's stated income was not verified. Under such market conditions, subprime borrowers, based on their credit history, who formerly would have been denied a loan, or offered a loan only at a high interest rate, found ready sources of funds. Low teaser interest rates attracted borrowers who failed to notice or understand the likely future jump in payment amounts when the initial rate period ended. The 228 adjustable rate mortgage, for example, offered a low rate for the first 2 years of the loan term, followed by an adjustment to the index plus margin rate for the remaining 28 years. Perhaps even scarier were the option ARMs that allowed a borrower to make a minimal payment, adding part of the interest owed to the remaining loan balance, thus evaporating what little equity might have been built up, and in some cases making the loan balance greater than the market value of the property. When the first of the adjustable subprime loans taken out at the height of the buying frenzy hit the readjustment point in mid-2006, a wave of loan defaults and foreclosures began to sweep across the country, a virtual financial tsunami for the housing market. As the number of properties on the market grew, prices began to 222 California Real Estate Principles 10th edition fall. Buyers still hesitated to pick up a bargain, in part because there was no way of knowing if the market had reached bottom, but also because of tightening of underwriting criteria by lenders. With fewer clients, many mortgage brokers laid off employees and some closed their doors for good. The subprime lenders and the buyers of the collateralized debt obligations, CDOs, that were backed by real estate assets of greatly diminished value took enormous losses. The crisis showed how far-reaching the residential mortgage market had become when financial institutions in Europe and Asia announced the devastating impacts of the American subprime lending crisis, with losses measured in their billions of dollars. In January 2008, Congress passed the Economic Stimulus Act of 2008 that, among other things, raised the limits on both conforming loans and those insured by FHA or guaranteed by VA. With the prospect of the U.S. government's involvement, it was hoped that the market for the affected loans would stabilize, and that borrowers would be able to refinance existing loans and also make new purchases. HERA. The Housing and Economic Recovery Act of 2008, HERA, was signed by President Bush on July 30, 2008. Some of its provisions were modified and additional provisions added by the American Recovery and Reinvestment Act of 2009, HERA, signed by President Obama on February 17, 2009. In November 2009, Congress further modified the legislation. Following is the latest status of some of the major provisions of the laws. Additional provisions are discussed in Unit 9, Government-Sponsored and Other Financing, and Unit 11, Real Estate Taxation. A new regulatory agency. The Federal Housing Finance Agency has replaced the Federal Housing Finance Board as regulator of the Federal Home Loan Banks. A low-income housing grants. This provision of RU allows states to trade in a portion of their 2009 low-income housing tax credits for Treasury grants to finance the construction or acquisition and rehabilitation of low-income housing, including those with or without tax credit allocations. A mortgage revenue bonds. HERA authorized $10 billion in mortgage revenue bonds for refinancing subprime mortgages. A neighborhood stabilization. HERA and RA authorized a total of $6 billion in funding for the Neighborhood Stabilization Program, which provides grants through the Community Development Block Grant Program (CDBG) to states and localities to address the problems that can be created when whole neighborhoods are decimated by foreclosures. The funds can be used to purchase, manage, repair, and resell foreclosed and abandoned properties and to establish financing methods for the purchase and redevelopment of foreclosed properties. Homes purchased must be used to assist individuals and families with incomes at or below 120% of area median income. At least 25% of the funds must be used for households with incomes at or below 50% of area median income. California_E_principles_10E_book.in 222 the 23rd of May 2017 2:29 and 7 seconds p.m. Unit 8 Financing Real Estate 223 HERA has imposed reporting requirements on mortgage brokers that are to be enacted and enforced by the states. California Senate Bill 36 was signed into law in October 2009 to comply with the Federal Secure and Fair Enforcement for Mortgage Licensing Act, SAFE Act, which is part of HERA. The reporting requirements regarding mortgage brokerage activities were added to the Business and Professions Code. The law requires all real estate brokers and salespersons acting under the supervision of a broker, who make, arrange, or service loans secured by real property. To report that fact to the California Bureau of Real Estate by January 31, 2010, or within 30 days of commencing the activity, whichever is later, using Form RE 866, Mortgage Loan Activity Notification, which is available at https://secure.dre.car.gov/licensing/nmls.asp and must be completed online. Identifying information required includes the licensee's name and real estate license number. If the licensee is a real estate corporation, the name and license number of the designated officer must also be provided. The form must identify the mortgage loan activities, including loan originations, being performed. The requirement applies to both residential and commercial businesses, and future business activity reporting will also be required. The penalty for failure to submit the required notification is $50 per day for the first 30 days the report is not filed and $100 per day for every day thereafter, not to exceed a maximum of $10,000. SB 36 and the SAFE Act impose additional requirements on any licensee who conducts activities as a residential mortgage loan originator, MLO. The licensee must do the following: A. Register on the Nationwide Mortgage Licensing System and Registry, NMLS, www.nationwidelicincingsystem.org. The NMLS contains a single licensed record-based record for each mortgage loan lender, broker, branch, and MLO. There is no fee to register. A. Satisfy the federal requirements for MLO licensure, which include new qualification assessments, federal and state examinations, and background checks. There are no exceptions to or exemptions from these requirements for existing licensees. A. Be issued an MLO endorsement on the individual's real estate license. Endorsement applications for qualified MLO registrants must be submitted electronically to the NMLS. MLO endorsements are issued annually and expire December 31 of each year. The endorsement carries a nationwide identification number, unique identifier, assigned by the NMLS. Each California real estate licensee is responsible for filing the necessary renewal and record update requirements to maintain the 4-year real estate license, apart from the requirements for the MLO endorsement. Penalty fees for failure to obtain a license endorsement are $50 per day for the first 30 days the report is not filed and $100 per day for every day thereafter up to a maximum of $10,000. https://secure.dre.car.gov/licensing/nmls.asp www.nationwidelicincingsystem.org California_RE_principles_10E_book.in 223 the 23rd of May 2017 2:29 and 7 seconds p.m. 224 California Real Estate Principles 10th edition. Dodd-Frank bill in response to the mortgage lending crisis and subsequent upheaval in financial markets, the Dodd-Frank Wall Street Reform and Consumer Protection Act, Financial Stability Act of 2010, was signed into law by President Obama on July 21, 2010. The act created the Financial Stability Oversight Council and the Office of Financial Research, both as part of the Treasury Department. The act also made the Office of Thrift Supervision, OTS, part of their Office of the Comptroller of the Currency, OCC. The merger was completed as of July 21, 2011, and the OTS no longer exists. The OCC now has supervisory responsibility for federal savings and loans and federal savings banks. Harp, the Home Affordable Refinance Program, Harp, introduced in March 2009, and later extended through September 30, 2017, has been made available to borrowers with little or no equity in their home. Harp allows such a borrower to refinance their mortgage with no new or additional mortgage insurance. No minimum credit score is needed and the borrower can get a lower interest rate, a shorter loan term, or a change from a fixed to an adjustable rate mortgage. Information on the program can be found at www.harp.gov. Appraisals with FIRA. the federal government introduced minimum requirements for appraisals, as well as appraiser licensing and certification. As of January 1, 1993, a property appraisal in a federally related transaction, such as a loan insured or guaranteed by a federal agency or a loan sold on the secondary mortgage market, should be performed only by an appraiser licensed or certified by the state in which the property is located, as discussed in Unit 13. The type of property and its estimated value determine whether appraiser licensing or certification is necessary. In addition, the appraisal itself must meet or exceed certain minimum standards. Property below a stated minimum value is exempt from the requirements. Real estate as security. Why would anyone lend as much money as most real estate transactions require? Because the loan can be backed by the property. Real estate loans in California generally are made using two instruments. The promissory note is the borrower's promise to pay the amount borrowed. The promissory note is evidence of the debt. It establishes their underlying obligation of the loan transaction. The security instrument is used to identify the real estate that serves as assurance that the loan will be repaid. With a security instrument, a property owner hypothecates the described real estate. Hypothecation means the real property will be forfeited to the holder of the security instrument if the underlying debt is not paid. www.harp.gov California_E_principles_10E_book.in 224 the 23rd of May 2017 2:29 and 7 seconds p.m. Unit 8 Financing Real Estate 225 Usury is the charging of an exorbitant amount or rate of interest and is the subject of both state and federal law. State law in 1979, California voters passed Proposition 2, which exempted from usury laws any loan made or arranged by a real estate broker and secured by real property. California law also exempts loans made by banks and savings and loan associations. Loans of credit unions, personal finance companies, and pawnbrokers are exempt unless the loan falls in one of the statutory categories mentioned below. 1. The maximum statutory interest rate that may be charged for consumer loans, money, goods, or other things intended for personal, family, or household purposes, other than loans for the purchase, construction, or improvement of real property, is 10% per year. 2. Money, goods, or other things intended for the purchase, construction, or improvement of real property are subject to a maximum rate of 10% or the prevailing Federal Reserve Bank discount rate plus 5%, whichever is higher. 3. Business loans are subject to a ceiling of the Federal Reserve Bank discount rate plus 5%. 4. The refinancing of a loan is subject to the same maximum rate as the original loan. Federal law when they cover the same subject. Federal law preempts state law. Federal law exempts federally related residential first mortgage loans made after March 31, 1980, from state interest limitations. This includes loans used to finance manufactured housing, mobile homes, and the acquisition of stock in a cooperative housing corporation. The federal act effectively limits the California usury laws to private lenders. Seller financing when a seller of real property extends credit for part or all of the purchase price. It is not considered a loan for purposes of the usury laws, but merely an extension of credit. The seller must act in good faith, however, or the transaction can be questioned. The process of hypothecation is similar to what occurs when personal property is pledged to secure payment of a loan. One important difference is that with a pledge, possession of the pledged property is turned over to the lender until the debt is paid. Think of the jewelry on display in a pawn shop window. The borrower typically retains possession of hypothecated real property, making it possible to enjoy the benefits of property ownership even when property is heavily mortgaged. The security instrument is what is commonly referred to as a mortgage. As you will learn, however, the legal document that serves as the security instrument can take the form of either a mortgage or a deed of trust, with very different results. California_E_Principles_10E_book.inp 225 the 23rd of May 2017 2:29 and 7 seconds p.m. 2:26 California Real Estate Principles 10th edition Promissory Note. The promissory note is a promise to pay money according to specified terms. The payment may be by installments that include both interest and principal, the amortized loan, or by installments of interest only with the principal due in a lump sum, a straight note. A combination of loan types also may be used, with a lump sum balloon payment due at the end of a specified term, during which only part of the principal is paid. A balloon payment is defined by the real estate law as an installment that is at least twice the amount of the smallest installment. Interest rates are allowed to reflect market trends by use of an adjustable rate note, described later in this unit. A loan can also call for payment of the entire amount due on demand of the holder of the note. An example of an installment note that specifies equal payments of both principal and interest appears in Figure 8.2. Joint and several liability. When more than one person signs a promissory note, there will probably be language in the note, such as the phrase jointly and severally, indicating that each cosigner is liable for the entire financial obligation imposed by the note. This joint and several liability means that, if one cosigner defaults in payment on the note holder can demand full payment from any other cosigner. Obviously, careful consideration should be given to any request to serve as cosigner on a note or other financial obligation. Cosigning a note also will affect the cosigner's credit record. Negotiable instrument. To qualify as a negotiable instrument, a promissory note must be an unconditional promise made by one person to another, a. in writing, an agreement to pay a specified amount of money on demand or at a fixed or determinable future time, a. payable on the order of a designated person or the bearer of the note, and a. signed by its maker. Figure 8.2, installment note interest included. If a promissory note qualifies as a negotiable instrument, the holder of the note, the one to whom the money is to be paid, can sell the note, give it away, or transfer the rights it represents in some other way. With a single instrument, an obligation to pay a large sum of money can thus change hands efficiently. California_E_Principles_10E_book.inp 227 the 23rd of May 2017 2:29 and 11 seconds p.m. 2:28 California Real Estate Principles 10th edition. A promissory note is a contract that may be enforced by the holder of the note or anyone to whom the holder assigns or transfers the right of payment. The person to whom the assignment is made is called the assignee or transferee. If all requirements for a negotiable instrument have not been met, the assignee or transferee has only the rights of the original holder of the note. If a promissory note meets all the requirements of a negotiable instrument, it attains a special status. Then a transferee or an assignee may be placed in a better position than the person from whom the note was received, if the transferee or assignee qualifies as a holder in due course, as described next. Holder in due course. A holder in due course is someone who takes a negotiable instrument, A for value, A in good faith, and A without notice of any defense against its enforcement that might be made by any person. A defense that a note maker could use to prevent the enforcement of a negotiable instrument could be a lack of consideration. The note maker never received the promised funds or property in exchange for the note. A prior payment. The note already has been paid off. A cancellation. The original note holder agreed to cancel the note obligation. A set-off. The original holder owes money to the note maker that should be applied to the note debt. Or a fraud in the inducement. The note maker created the note based on fraudulent representation by the payee. Consumer credit. The Federal Trade Commission has limited the rights of a holder in due course in consumer credit contracts for goods or services. Subsequent holders of such contracts are subject to all the same defenses the maker could bring against the original holder. This provision applies to real estate only in the case of contracts for particular building improvements added after initial construction, such as siding. The holder in due course, or anyone who acquires a negotiable instrument from a holder in due course, is not bound by the above defenses. A holder in due course can insist on collecting on the note, even if the note maker can claim one of the above defenses against the original note holder. A holder in due course still may not be able to enforce the instrument, however, if the note maker lacked the legal capacity to make a legal agreement the note was forged. The person who receives an assignment is the assignee or transferee. California_principles_10e_book.inp 228 the 23rd of May 2017 2:29 and 11 seconds p.m. Unit 8 Financing Real Estate 229. The instrument involves an illegal activity or there has been a material alteration in the terms of the note, although a subsequent holder in due course can claim payment according to the note's original terms. For example, Ben Phillips has purchased the Simon residence, giving a promissory note for $292,000 to his Aunt Fran, who lent him the money to buy the house. Ben promised to pay 7% interest on the loan. Aunt Fran gave the note to her niece Marjorie, who altered the note to read 17% interest. Marjorie then sold the note to an investor, who had no knowledge of the alteration. The investor informed Ben of the address to which the monthly payments should be sent. When Ben's monthly payments fell short of the 17% interest rate, the investor sent a reminder of the discrepancy. Does Ben have to pay the 17%? What does Ben have to do? Even though the investor probably qualifies as a holder in due course, Ben can claim that the note was materially altered and refuse to pay 17%. Ben still must keep up the payments at the original rate of 7%. However, math concepts real estate loan interest payments can be computed in two steps. 1. Principal rate equals annual interest. The principal is the unpaid balance of the loan. The rate is the percentage rate of interest paid. 2. Interest on a loan ordinarily is calculated monthly. To find interest per month, divide the annual interest by 12. Example, calculate the interest to be paid for 1 month on a loan with a remaining balance of $176,000, when the interest rate is 6%. Principal rate equals annual interest $176,000 .06 equals $10,560 $10,560 middle. 12 equals $880 monthly interest. To find interest for a number of days, find the daily interest by dividing the annual interest by 360 days in the year, unless the exact number of days in the year is required. Then, multiply the interest per day by the number of days for which interest is owed. Example, calculate the interest to be paid for 17 days on a loan with a remaining balance of $176,000, when the interest rate is 6%. $176,000 .06 equals $10,560 annual interest $10,560 middle. 360 equals $29.33 daily interest $29.33 $17 equals $498.67 interest for 17 days. Another way to find daily interest is to divide the annual interest by 12 and then divide that number by 30. If you don't have calculator, that may be easier than dividing the annual interest by 360. California_E_principles_10e_book.inp 229 the 23rd of May 2017 2:29 and 11 seconds p.m. 2:30 California Real Estate Principles 10th edition. Security instrument. The security instrument hypothecates the property that serves as the lender's assurance that the underlying debt will be repaid. The process of hypothecation, as described earlier, is similar to a pledge, but the property owner retains possession of the property. The security instrument is commonly referred to as a mortgage, although it may take one of several forms, only one of which technically is a mortgage. It is not commonly used in California, even though the mortgage was the first security instrument used in the state. The deed of trust now is the preferred security instrument in California. Whether it takes the form of a mortgage or deed of trust, the security instrument will be recorded to provide constructive notice of the lien rights of the lender. Mortgagor mortgage is an instrument by which property is hypothecated to secure payment of a debt or an obligation. A lien on the property is given by the mortgagor, borrower and property owner, to the mortgagee, lender. In the event of the mortgagor's default before final payment, the mortgagee's remedy is judicial, court-ordered, foreclosure. As an alternative, the mortgage instrument could contain a power of sale provision. A mortgage with a power of sale clause operates as a trust deed does when property is sold at a trustee's sale. Discussed later in this unit. The procedure for judicial foreclosure changed as of July 1, 1983. Instruments that originated before that date follow the old rules, and instruments as of that date follow the new rules. If you are involved in any foreclosure matter, always consult an attorney. In a judicial foreclosure, the court orders the property sold to the highest bidder. At public auction in the county where at least part of the property is located, the court appoints a commissioner or orders the sheriff to carry out the sale. Statutory notice requirements must be met. If the bid price exceeds $5,000, the successful bidder has the option of depositing the greater of $5,000 or 10% of the amount bid and paying the balance within 10 days of the sale. If this option is chosen, the bidder also must pay additional costs and interest that accrue between the sale and the date of payment. If full payment is not made within 10 days of the sale, a new sale is conducted and the defaulting buyer is liable for costs of the original sale and resale, interest, attorney's fees, and the amount of the original bid less the amount bid for the property in the subsequent sale. If no acceptable bid is received, the sale can be postponed. The commissioner or sheriff delivers to the purchaser a certificate of sale, which should be recorded immediately. The security instrument usually is referred to as a mortgage, even when it is a deed of trust. California_E_principles_10E_book.in 230 the 23rd of May 2017 2:29:11 p.m. Unit 8 Financing Real Estate 231. The old rule on sales stemming from instruments that originated before July 1, 1983, a junior lender, such as a second mortgage holder, also has a right of redemption. The redemption period is 3 months following the sale if the sale proceeds were sufficient to cover their remaining indebtedness plus interest and costs of foreclosure. Otherwise, the redemption period is 1 year, unless the mortgagee waives or is prohibited from obtaining a deficiency judgment. The buyer must consider the risk of redemption when deciding how much to bid for the property. Obviously, there are relatively few outstanding mortgages that originated before July 1, 1983. Nevertheless, a buyer at a foreclosure sale should be interested in the date of origination of all liens on the property. The proceeds of a foreclosure are used to pay off the remaining indebtedness on the property. Any funds left over go to other lien holders in order of priority. The last recipient is the mortgagor. If the sale proceeds do not cover the indebtedness plus court costs and sale fees, the mortgagee can obtain a deficiency judgment for the remaining debt against the mortgagor personally. Unless either mortgage was a purchase money debt, the mortgagee was the seller of the property, or either loan was to pay all or part of the purchase price of an owner-occupied residential dwelling of no more than 4 units. California_E_principles_10E_book.in 231 the 23rd of May 2017 2:29:11 p.m. 232 California Real Estate Principles 10th edition. Anti-deficiency of the Homeowners Safety Net. California Code of Civil Procedure 580B. As long as market demand exceeds supply and prices continue to rise, California homeowners usually don't need to worry about foreclosure. Even when an individual has difficulty making loan payments, the sale of the property will relieve the owner of the payment burden and most likely will provide a profit over the purchase price. But what happens when the market takes a turn for the worse? And what about the worst-case scenario of the current market value of the property is less than the remaining loan balance? That's when California's anti-deficiency protection provides the ultimate safety net for homeowners. If a homeowner can no longer continue to make payments on a loan secured by a mortgage or deed of trust on the home, the only recourse for the lender is to take back the property. Even if the current market value of the property is less than the outstanding loan balance, the lender cannot seek a judgment against the defaulting homeowner for the difference. This protection is automatic, so long as the loan is the one that the owner used to purchase the property. It even extends to situations in which a chattel mortgage is given for the purchase of personal property, such as furnishings, as part of the original home acquisition. In that case, the anti-deficiency protection covers both loans. SB 931, which applies to loans secured by a first lien and which took effect on January 1, 2011, and SB 458, which applies to loans secured by a second lien and which took effect July 15, 2011, have clarified the borrower protection in the event of a short sale for less than the amount of the remaining loan balance. Section 580E now provides that no judgment shall be rendered for any deficiency under a note secured by a deed of trust or mortgage for a dwelling of not more than 4 units, in any case in which the trustor or mortgagor sells the dwelling for less than the remaining amount of their indebtedness due at the time of sale with the written consent of the holder. The protection does not apply, however, if the original home loan was refinanced. It also does not apply to any home equity loan taken out after the original purchase. The potential benefit of the law is thus greatest for homeowners who incur the maximum indebtedness at the time the property is first acquired and resist refinancing the purchase loan, and or taking out a home equity loan before a foreclosure sale. The mortgagor or anyone with a subordinate lien or encumbrance on the property may cure default by paying all delinquencies, including court costs and fees that result from the foreclosure. The mortgage thus is placed back in effect in a process called reinstatement. The least desirable aspect of judicial foreclosure is that it is time-consuming. Not only does it take many months for the sale to take place, the purchaser at a foreclosure sale receives only a certificate of sale. The purchaser does not receive possession until after the statutory redemption period, a period following the sale during which the judgment debtor or the judgment debtor's successor in interest can buy back the property. When a mortgage debt has been satisfied, the mortgagee must execute a certificate of discharge, which is recorded with the county recorder. Otherwise, the mortgage lien may act as a cloud on the owner's title. 233 Deed of Trust. It will soon become obvious, as we go over the characteristics of the deed of trust, why this is the security instrument preferred by lenders who make loans in California. A deed of trust, or trust deed, is an instrument by which real property is hypothecated to secure payment of a debt or an obligation. The title to the property is transferred by the trustor, owner and borrower, to the trustee, a neutral third party, to hold on behalf of the beneficiary, lender, until the debt is repaid, even though the borrower retains possession. In the event the trustor defaults on the underlying debt, the trustee is instructed to sell the property and transfer the money obtained at the sale to the beneficiary as payment of the debt. An example of a deed of trust appears in Figure 8.3. Someone other than the borrower could place title to property in trust to secure borrower's loan, but the trustor is usually the borrower. For example, a loan made to a business could be secured by a mortgage on the home of one of its officers. On the trustor's default, the beneficiary has the option of requesting a trustee's sale or a judicial foreclosure, the same remedy available with the mortgage. Neither choice prevents the other from ultimately being used before the sale is carried out, although the 4-year statute of limitations will be applied to a judicial foreclosure. A trustee's sale is made possible by the provisions of the trust instrument. On default by the trustor, the beneficiary informs the trustee of that fact by a declaration of default, which states the reason for the default. The beneficiary includes the original note and trust deed with the declaration. The form of notice of default that appears in Figure 8.4 became effective June 1, 1985. The first statement in the notice must be printed in bold type. The notice must be in Spanish if the trustor so requested or if the contract was negotiated in Spanish. The beneficiary or trustee must state that the entire debt is due because of the default, or it cannot be collected at the sale. 234. Figure 8.3 Short-form deed of trust and assignment of rents. Figure 8.4. Notice of default. 237. The notice of default is sent by registered or certified mail to either trustor, any successor in interest to the trustor, a junior lenholders, other state controller, if there is a tax lien on the property, and anyone who has filed a request for notice with the county recorder. If any parties other than the original trustor are involved, notice is also published in a newspaper of general circulation once a week for 4 weeks. The California Foreclosure Prevention Act has extended the waiting period between filing of the notice of default and filing of the subsequent notice of sale from 90 days to 180 days, effective June 15, 2009. But the Act exempts from the extension lenders with comprehensive loan modification programs. Notice must be made to the borrower at least 20 days before a foreclosure sale by mail to the defaulting borrower, as well as by posting at the property that is the subject of the foreclosure and in a public place in the county where the sale is to occur. A debt under a trust deed or mortgage can be reinstated if payment of the overdue amount is made at any time after the notice of default is recorded, but no later than 5 business days before the date of sale. Some deed of trust forms provide for a longer period of reinstatement too. If so, the longer period will apply. A junior lenholder can pay the amount in arrears, which would then be added to the debt owed under that obligation. The trustor always has the opportunity to prevent a sale by paying the entire debt owed, plus the costs and fees accumulated. At the sale itself, the beneficiary lender can credit bid up to the amount of the debt owed. Otherwise, payment is by cash, cashier's check from a qualified lender, or a cash equivalent designated in the notice of trustee's sale as acceptable to the trustee. Postponement of the trustee's sale if no acceptable bid is received, or if more than one sale has been scheduled for the same time, the trustee's sale can be postponed. Postponement of the sale revives the right of reinstatement as of the date the new notice of sale is recorded, and it continues until 5 business days before the new date of sale. The same rule applies to any further postponement. There is no limitation on the number of postponements, but if the sale does not occur within 365 days of the notice of sale, a new notice of sale must be given before any further sale proceedings may be scheduled. The most significant difference between a mortgage and a trust deed, or mortgage with power of sale, is that there is no right of redemption following a trustee's sale. The sale is absolutely final, and the purchaser can take possession immediately. A bidder at such a sale will understandably be willing to offer a higher price than if the sale were a judicial foreclosure. Being entitled to possession is small comfort to the purchaser if the former owner refuses to vacate the premises. An unlawful detainer is the legal action by which California_E_principles_10E_book.in 237 the 23rd of May 2017 2:30 and 16 seconds p.m. 238 California Real Estate Principles 10th edition. The court orders the sheriff to evict the present occupant. The purchaser at a trustee's sale must also take such an eventuality into account. The fact that there is no right of redemption helps minimize the lender's risk, for there is a greater chance that if the borrower defaults, the debt will be repaid in full by a trustee's sale. This is true even though sale by exercise of the power of sale by the beneficiary or mortgagee, rather than sale by judicial foreclosure, automatically bars any deficiency judgment in the event the sale proceeds fail to cover the unpaid balance of the debt plus interest, court costs, and sale fees. Following a satisfaction, payoff, of the debt or obligation underlying a deed of trust, the beneficiary, or assignee or transferee of the beneficiary, delivers the original note and deed to the trustee and requests a reconveyance to the trustor. The reconveyance of title to the trustor by the trustee is accomplished by the trustees executing to the trustor a deed of reconveyance, which is recorded in the county recorder's office. The original note and deed of trust can then be delivered to the trustor on the trustor's written request. On satisfaction of the debt, the beneficiary, mortgagee, is obligated to clear their trustors, mortgages, title. Failure to do so can subject the beneficiary, mortgagee, to civil or criminal penalties. The trustee also can be penalized for failure to comply with statutory requirements. Deed in lieu of foreclosure. A deed may be used to transfer property to the beneficiary of a trust deed with the beneficiary's consent, to prevent a forced sale. Transfer of the property to the beneficiary may be to the beneficiary's advantage if the property is worth at least the amount of the remaining debt. The trustor benefits by avoiding the publicity of a public foreclosure sale. A danger arises when the property is worth more than the outstanding debt owed to the beneficiary. In that case, the beneficiary should pay the difference to the trustor, or the transfer could be challenged later in court. Conclusion. To summarize, the differences between mortgage and trust deed lie in the A number of parties, A conveyance of title, A statute of limitations, A available remedies on default, A period of reinstatement, A availability of redemption, A availability of deficiency judgment, and A procedure following satisfaction of the debt. Most important is that the trust deed offers the lender a relatively faster and cheaper means of protecting the security interest. Sale of the encumbered property is a last resort, however, no matter what form the sale takes. The lender may vary. When the debt is repaid, title is deeded back to the trustor. California_E_Principles_10E_book.in 238 the 23rd of May 2017 2:30 and 16 seconds p.m. Unit 8 Financing Real Estate 239 will be the only bidder at the sale, and owning the property is an alternative most lenders do not welcome. When a mortgage is really a deed of trust, the term mortgage is used generically to refer to any security device. In California, that device, instrument, most often takes the form of a deed of trust. The trustor, borrower, trustee, third party holding title, and beneficiary, lender, are the parties involved in a deed of trust. When we refer to a mortgage in the rest of this and the next unit, however, we will mean any real property security instrument. By mortgagor we will mean the borrower under any form of security instrument, and by mortgagee we will mean the lender under any form of security instrument. In the same way, the term foreclosure most often means a trustee's sale. The use of what may appear to be the wrong terminology simply is recognition of the fact that for most of the country, those are the correct terms. California Foreclosure Reduction Act. The California Foreclosure Reduction Act, also known as the California Homeowner Bill of Rights, took effect on January 1, 2013, and makes changes to non-judicial foreclosures in California. Much of the law concerns mortgage servicers that have foreclosed on more than 175 homes during the preceding calendar year. The law has many important provisions, including the possibility of civil penalties and criminal prosecution, which include the following. The mortgage servicer is prohibited from commencing or continuing a foreclosure while a loan modification application submitted by a borrower is pending. The mortgage servicer must provide a single point of contact for a borrower who has requested a foreclosure prevention alternative. The borrower must be provided a written acknowledgement of receipt of a completed loan modification application or related documents within 5 business days. The initial acknowledgement of the loan modification application must describe the modification process, note any deficiencies in their application, and provide an estimate of when a decision will be made, the length of time the borrower will have to consider an offer, and any deadlines or expiration dates for submitting documents. A written notice is required if a loan modification application is denied and a notice of default cannot be recorded, or the notice of sale cannot be recorded, if the notice of default has already been recorded, until the later of 31 days after the borrower is provided with the notice of denial, or, if the borrower appeals, the later of 15 days after denial of the appeal or 14 days after a loan modification is offered after appeal but declined by the borrower, or, if a loan modification is offered after appeal and accepted, the date on which the borrower defaults or breaches the terms of the offer. Before beginning the foreclosure process, The mortgage servicer must review competent and reliable evidence to substantiate the default. All parts of the process must be supported by competent and reliable evidence. A lender that records and files multiple unverified documents will be sub California _E_principles_10E_book.in 239 the 23rd of May 2017 2:30 and 16 seconds p.m. 240 California Real Estate Principles 10th edition. Subject to a civil penalty of up to $7,500 per loan. A lender who is in violation is also subject to enforcement by a licensing agency, including the California Department of Business Oversight and the California Bureau of Real Estate. A borrower can seek redress in the event of material violations of the new foreclosure process protections. Injunctive relief is available before a foreclosure sale, and damages can be recovered after a sale. The statute of limitations to prosecute mortgage-related crimes is extended from 1 to 3 years, and the Attorney General's office can use a statewide grand jury to investigate and indict the perpetrators of financial crimes involving victims in multiple counties. In addition, a purchaser of a foreclosed home must give tenants at least 90 days before starting eviction proceedings. If the tenant has a fixed-term lease that began before the transfer of title at the foreclosure sale, the new owner must honor the lease unless the new owner can prove that an exception intended to prevent fraudulent leases applies. A list of the mortgage services licensed and regulated by the Department of Business Oversight with more than 175 foreclosures in calendar year 2012 is posted online at www.car.gov/laws_car_foreclosure_reduction_act.asp. Untitled Act Mortgages and Deeds of Trust. California's Untitled Civil Rights Act covers contracts for goods and services. If a mortgage with a power of sale clause or deed of trust on a single-family owner-occupied residence stems from a contract that falls within the Untitled Act, even more explicit notice must be given to a trustor or mortgagor in default. The Act also prohibits discriminatory language in real property instruments for the purpose of restricting the conveyance, encumbrance, lease, mortgage, use, or occupation of property. The object of this special provision is to prevent a homeowner from unwittingly losing the home as the result of a retail installment purchase. The requirements for imposing a mortgage or deed of trust, as well as the requirements on default, can be found in the Civil Code. Home equity sales contracts. The high rate of overall property appreciation in recent decades greatly increased the equity of owners of real estate throughout the state. Increased equity has made properties attractive to unscrupulous individuals seeking to take advantage of homeowners whose property is in foreclosure. By use of a home equity sales contract, the property owner in foreclosure may be persuaded to sell the equity in a www.car.gov/laws_regs/legislation/car_foreclosure_reduction_act.asp. California_E_Principles_10E_UO8.in 240 the 6th of January 2017 12:54 and 31 seconds p.m. Unit 8 Financing Real Estate 241. Home for far less than its true value. The problem became severe enough to warrant legislation now included in the Civil Code. The law provides the following. A home equity sales contract must be in letters equal to 10-point bold type. This sentence is printed in 10-point bold type. The contract must include notices of the equity seller's right of cancellation. The contract may be cancelled by the equity seller at any time up to midnight of the 5th business day following the contract signing, or 8 a.m. on the day set for sale under a deed of trust, whichever comes first. There are exceptions to these requirements for properties sold for use as a personal residence, by deed in lieu of foreclosure, trustee's sale, foreclosure sale, as authorized by statute or a court, or between blood relatives or their spouses. Penalties for violation of the law include a fine of up to $10,000, imprisonment for up to 1 year in the county jail or state prison, or both. The equity seller can recover damages, attorney's fees, and costs. Finally, Any transaction involving residential real property in foreclosure in which any person initiating, entering into, negotiating, or consummating the transaction takes unconscionable advantage of the property owner is voidable and can be rescinded within 2 years after the sale. Other foreclosure abuses. The California Civil Code also covers the abuses of mortgage foreclosure consultants. In Section 2945A, the legislature states that homeowners whose residences are in foreclosure are subject to fraud, deception, harassment, and unfair dealing by foreclosure consultants. To combat these practices, the law specifies notice and other requirements that must be scrupulously followed by anyone, other than those exempted from the provision, who offers to stop or postpone a foreclosure sale, assist in obtaining a loan or an extension for payment, or perform other activities involving property in foreclosure. Though attorneys and real estate licensees are generally exempted from these requirements, SB 94, effective until January 1, 2013, bans all foreclosure consultants, including loan modification attorneys and firms, from asking for any advance fees before fully completing the services contracted, whether successful or denied by the loan servicer. In 2010, AB 2325 expanded the foreclosure consultant restrictions to anyone who performs a forensic audit, an audit performed as part of a legal action, of a residential mortgage loan. Abuses by mortgage foreclosure consultants are taken very seriously. Violation of the law could result in both civil and criminal penalties, including fine, imprisonment, or both. 242 California Real Estate Principles 10th edition. Exercise 8.1 Identify the security instrument described in each of the following situations. 1. Harvey and Helen Headstrong have purchased Whitaker. If they default on their loan payments, they can have the loan reinstated or redeem their property if it is sold at the lender's request. 2. Bernice Bosch has purchased Blackacre. She holds title to Blackacre. If she defaults on her loan payments and Blackacre is sold at the lender's request, she cannot redeem it. 3. Mel and Millie Menz have purchased Greenacre and are living there, even though they have conveyed title to someone else. 4. Alan Admer bought Redacre. He defaulted in his loan payments and received notice that Redacre would be sold. The day before the sale, Alan offered to pay the overdue installments and costs but was surprised when the lender demanded that the entire loan balance be paid to stop the sale. Real estate lenders are the primary mortgage market. Lenders who initiate loans with borrowers are part of what is called the primary mortgage market. There are both institutional and non-institutional lenders in the primary mortgage market. Institutional lenders make most of the loans used by home and business owners. Depository institutions include those that lend money for the purchase or a financing of real estate or for the construction of improvements. Such institutions act as intermediaries between the borrowers and the sources of the funds the institution has available to lend. As discussed previously, those funds are typically savings or investments. Savings and loan associations. Most California savings and loan associations, SLs, are federally chartered. All are required by state law to insure accounts through the FDIC. California_E_principles_10E_book.in 242 the 23rd of May 2017 2:30 and 16 seconds p.m. Unit 8 Financing Real Estate 243 Loan-to-value ratio and PMI. The loan-to-value ratio is the percentage of the current appraised market value represented by the amount of the loan. In other words, what percentage of the value does their loan represent? If the loan-to-value ratio exceeds 80%, the borrower must obtain insurance for the loan amount over 80%. Private mortgage insurance, PMI, typically added to the monthly loan payment, will automatically be discontinued after the loan has been paid down to 78% of the original sales price, as required by the Federal Homeowners Protection Act of 1998, HPA. The borrower has the right to request cancellation of PMI when the loan balance is no more than 80% of the original purchase price or appraised value at the time of purchase. whichever is less. The deductibility of PMI payments was approved by Congress for policies issued in 2007, and was later extended for PMI payments made through 2013. Federally chartered DSLs, also called thrift and loans or just thrifts, are members of the Federal Home Loan Bank System. The Board of Governors of the Federal Reserve System establishes minimum reserve requirements. A loan is an open-ended mortgage if it permits the mortgagor to borrow additional money at will without further financial qualification, on the original loan terms. A lock-in clause in a promissory note or land contract prohibits the promisor from paying off the debt before the date set forth in the contract. Home loan payment terms may be described as a fully amortized. Equal payments including both interest and principal are made over the loan term. A partially amortized, most of the principal remains to be paid in the last payment. A non-amortized, the straight note, typically interest only, with the entire amount of principal due at the end of the loan term, or as having a negative amortization. Loan payments do not cover all of the interest due, which is then added to the remaining loan balance. Figure 8.5 summarizes important features of some of the most widely used real estate loans. Commercial banks. All banks must be members of the Federal Reserve System. The National Bank Act covers national banks. The California banking law covers state banks. Commercial banks make the broadest range of loans, including those for real estate purchase, construction, and interim financing, before a building under construction is completed, and even consumer loans for home improvements. Commercial banks also make many business and short-term credit loans, including automobile financing. Bank credit cards represent a growing portion of commercial banks' activity. Banks make the greatest number of different types of loans. California_E_principals_10E_book.in 243 the 23rd of May 2017 2:30 and 16 seconds p.m. 244 California Real Estate Principles 10th edition. There are no restrictions on loan-to-value ratios or amortization schedules or limitations on the amount of funds that can be loaned on real estate by national banks. This is one reason why this form of institution is becoming increasingly popular. Commercial banks are supervised by the U.S. Comptroller of the Currency. Insurance companies, with the exception of single-family homes, insurance companies invest in most types of real estate by making mortgage loans. Insurance companies are governed by the laws of the state of their incorporation as well as by the laws of the state in which they do business. Insurance companies typically finance large commercial projects but also buy loans from mortgage companies, discussed later in this unit, and invest in government-insured or guaranteed loans. Mutual savings banks. A mutual savings and loan association distributes its earnings to depositors, after providing for expenses, reserves, and other costs of operation, as dividends, rather than interest. Originally found in the New England states and relatively new to California, both mutual and stock savings and loan associations have reformed as mutual savings banks. They can retain federal deposit insurance and follow federal regulations. They can also be state-chartered. Credit unions of growing importance are the loan-making functions of credit unions, which are organized under the National Credit Union Administration, a federal agency. Credit unions receive the savings of members, frequently through payroll deductions, which they use to make loans to members. Loans may be unsecured but more often are secured by a home, an automobile, a boat, or other asset purchased. Credit unions typically have relatively low overhead expenses. As a result, many credit unions can offer loans at competitive interest rates while also offering interest rates on savings accounts and other investments that may be better than those offered by commercial banks and savings and loans. Participation is restricted to the defined group of prospective members, such as federal employees. Non-institutional lenders. Non-institutional lenders include A. mortgage companies, A. private individuals, and A. organizations that are not financial institutions. California_E_principles_10E_book.in 244 the 23rd of May 2017 2:30 and 16 seconds p.m. Unit 8 Financing Real Estate 245. Figure 8.5 Common mortgage plans. Loans from federal institutions on borrower-occupied homes. Loan type description. Advantages, disadvantages. Fixed rate mortgage. Fixed interest rate equal monthly payments of principal and interest until debt is paid in full. Stable, with long-term tax advantages rarely assumable. Adjustable rate mortgage, ARM, also called flexible rate or variable rate mortgage. Interest rate changes based on index could increase payments, term, or principal. Could have rate cap or payment cap. Very popular with lenders. Rate cap of no more than 5% advisable. With payment cap, negative amortization possible, usually assumable. Graduated payment mortgage, GPM. Lower monthly payments rise gradually over 5 to 10 years, then level off for remainder of term. Easier to qualify for. Graduated payment adjustable rate mortgage, GPAM. Same as GPM, but additional payment change possible if index changes. Easier to qualify for. Could be negative amortization. Growing equity mortgage, GEM, also called rapid payoff mortgage. Fixed interest rate payments vary by index or schedule. Rapid payoff as payout increases. Income must also increase. Reverse annuity mortgage, RAM, also called equity conversion mortgage. One-time or monthly payments are made to borrowers age 62 or older using property as collateral. Provides cash to homeowner. Loan amount plus accrued interest is due when property is sold or at homeowner's death. High closing costs require independent loan counseling for homeowner. Renegotiable rate mortgage, RRM, also called rollover mortgage. Rate and payments constant for 3 to 5 year intervals. Can change based on FHLBB index rate cap of 5% over maximum 30-year term. Fair stable payments due to less frequent changes in rate. Shared appreciation mortgage, SAM. Below market rate and lower payments in exchange for losing some equity. Loss of equity makes investment more expensive. Mortgage companies, or mortgage bankers, make real estate loans, then sell those loans to investors. The mortgage company will service the loans it has sold on a contractual basis. Servicing a loan includes receiving payments on behalf of the investor and otherwise handling the day-to-day supervision of the investment. Mortgage companies are a prime source of government-insured and guaranteed loan funds as well as conventional loans. Loans that do not involve government cooperation. State laws regarding mortgage companies historically have been much broader than those governing banks and SLs. Many mortgage companies invest their own funds or borrow investment funds themselves from commercial banks. California_E_principles_10E_book.in 245 the 23rd of May 2017 2:30 and 16 seconds p.m. 246 California Real Estate Principles 10th edition. Mortgage bankers versus mortgage loan brokers. Even though the mortgage banker often serves as a middleman between investor and borrower, the mortgage banker is not necessarily a mortgage broker. In California, mortgage bankers are licensed by the California Department of Business Oversight and are subject to the California Residential Mortgage Lending Act, CRLA, found in the California Financial Code. Mortgage loan brokers are licensed as real estate brokers by the California Bureau of Real Estate and are governed by the California real estate law. They bring borrower and lender together but typically do not invest their own funds, and they do not service loans. Private individuals, non-financial institutions and private individuals hold 1/4 of all mortgage debt. Private individuals are the largest source of seconds on mortgage funds, junior loans. When the lender is an individual, rather than a bank or mortgage company, there won't be a loan committee or arduous qualification process. In addition, an individual may offer lower loan costs and a better interest rate. When individuals make direct loans, as opposed to extending purchase money credit, they are subject to the usury laws, unless a broker has arranged the loan. Non-financial institutions. Real estate loans make up some of the most important assets of non-financial institutions. These include A. pension funds, A. colleges and universities, A. trusts, A. estates, A. mortgage investment companies, and A. Other groups. As with individuals, non-financial institutions may make fewer demands in terms of borrower qualifications. Such investors are also unlikely to be part of the primary mortgage market for single-family homes. Mortgage loan brokers. California's real property loan law, a part of the real estate law, allows a real estate broker to solicit borrowers or lenders or negotiate loans for real property. 247. Figure 8.6. Maximum mortgage loan broker commission. Type of security: loan amount, loan term, maximum commission. First deed of trust less than $30,000, $30,000 or more, 3 years or more, less than 3 years, 10% of loan amount, 5%. Second deed of trust less than $20,000, $20,000 or more, 3 years or more, 2 to less than 3 years, less than 2 years, 15% of loan amount, 10%, 5%. The real property loan law applies to loans secured by equity in real property, but it does not apply to purchase money loans. Put another way, the law applies to hard money, cash out, as opposed to soft money loans, those used to buy the property. A broker can loan his own funds if the borrower is informed of the source of the funds. If funds from a family member of the broker are loaned, the relationship also must be disclosed. The maximum commission that a broker can charge for negotiating or making a loan depends on A. the amount of the loan, A. the length of the loan term, and A. whether the loan is secured by a first or second deed of trust. Maximum commission amounts are summarized in Figure 8.6. Costs and expenses, such as appraisal fees, credit investigation fees, notary fees, and escrow fees, can be charged in addition to the commission or broker's fee. The maximum that can be charged for such costs and expenses, excluding title charges and recording fees, is shown in Figure 8.7. If a loan is negotiated or made by a broker, a mortgage loan disclosure statement must be completed and presented to the borrower for the borrower's signature before the loan transaction is completed and the borrower becomes obligated under the terms of the agreement. This statement is separate from any other required disclosure statement. Figure 8.7. Maximum chargeable mortgage loan broker costs and expenses. Loan amount, maximum costs and expenses up to $7,800, $7,800 to $14,000, more than $14,000. Actual costs or $390, whichever is less. Actual costs or 5% of loan amount, whichever is less. Actual costs, but not more than $700. As of January 1, 2004. The real estate law allows brokers to arrange multi-lender loans that are secured by more than one parcel of real property. Form revisions effective as of January 2004 are Re 851A Lender, Purchaser Disclosure Statement, Loan Origination, Re 851B Lender, Purchaser Disclosure Statement, Sale of Existing Note, and Re 851D Lender, Purchaser Disclosure Statement. A multi-property cross-collateralization addendum. All of the new forms are available at www.bud.car.gov. A sample lender purchaser disclosure statement is shown in Figure 8.8. www.bud.car.gov. California_E_principles_10E_UO8.im 247 the 24th of May 2017 10:38 and 24 seconds AM 248 California Real Estate Principles 10th edition. Advertising by a mortgage loan broker must include a statement that the broker is licensed by the California Bureau of Real Estate. Other restrictions on mortgage loan brokers. There are other restrictions on loans made by brokers that are not greater than $30,000 for a first mortgage or $20,000 for a second mortgage. They include the following: a no balloon payment, a payment more than twice the amount of the smallest payment, is required on an owner-occupied dwelling if the loan term is less than 6 years, 3 years for property not owner-occupied, unless the loan is taken back by the seller as part of the purchase price. No borrower-paid loan servicing or loan collection fees are assessed. A borrower may not be required to obtain credit life or disability insurance as a loan condition if the broker provides such insurance. Only one premium may be collected, and only a borrower who might be expected to contribute to loan payments, such as a wage earner, may be insured. The penalty for late payment of an installment is limited to 10% of the principal and interest payment. Payments may be made within 10 days of the date due without penalty. On loans of any amount secured by a borrower-occupied dwelling, no prepayment penalty is allowed after 7 years from the date the loan was made. In the first 6 years of the loan, 20% of the loan principal can be paid off per year without penalty. Otherwise, the maximum prepayment penalty is 6 months interest on prepayments of principal that are greater than 20% of the unpaid principal balance. Unit 8. 249. Figure 8.8. Lender, Purchaser Disclosure Statement. 255. For example, mortgage loan broker Mary Miller arranges a $20,000 loan secured by a second deed of trust for a homeowner who wants extra cash to pay off some credit cards. The loan term is 15 years. Mary's commission is 10% of the loan amount, and loan expenses include an appraisal fee of $350, a credit report of $40, and notary fees of $50. What is the total maximum fee that Mary can charge on this loan, including brokerage commission and expenses? Mary's commission is $20,000. A minus 10% equals $2,000. Expenses are $350 plus $40 plus $50 equals $44. Both Mary's commission and the expenses come within the limitations of the real property loan law. The total maximum fee thus is $2,000 plus $440. Or $2,440. California Residential Mortgage Lending Act. Some lending activities are conducted under the rules of the California Residential Mortgage Lending Act. The law applies to those involved in making or servicing mortgage loans on 1 to 4 family dwellings. The Department of Business Oversight, www.dbo.car.gov, issues licenses for the activities covered by the law, but the following are exempt. Real estate brokers licensed in California. Institutional and non-institutional lenders already licensed by the state or federal government, such as banks, savings and loan associations, trust companies, and insurance companies. An individual or company making residential mortgage loans with his, her, or its own money. A government and pension plan employees. A court-appointed estate or other representatives. A trustee under a deed of trust. The law also exempts a California finance lender licensed under the California Finance Lenders Law. A finance lender is someone who is in the business of making consumer loans or commercial loans in which personal property may be used as collateral. www.dbo.car.gov. California_E_principles_10E_book.in 255 the 23rd of May 2017 2:30 and 27 seconds p.m. 256 California Real Estate Principles 10th edition. Exercise 8.2 Loan charges usually include not only the interest rate but also a loan origination fee, points, and other costs. Make a survey of loan charges by at least 3 online lenders who make loans in California. Base your comparisons on both a fixed rate and an adjustable rate loan of $320,000, representing 80% of the value of a home selling for $400,000, with a down payment of 20%. As a further comparison, use loan terms of both 15 and 30 years. You can begin your survey by entering the search term home loan in one of the internet search engines, such as Google or Yahoo. You could also check out some of the online property listing services, which include www.realtor.com, www.homeagain.com, www.realestate.com, and www.zillow.com. Federal Disclosure Requirements. What is TRID? The TILA-RESPA Integrated Disclosure Rule, TRID, consolidates 4 existing disclosures required under the Truth in Lending Act, TILA, and the Real Estate Settlement Procedures Act, RESPA, for closed-end credit transactions secured by real property into 2 forms: a loan estimate that must be delivered or placed in the mail no later than the 3rd business day after receiving the consumer's application, and a closing disclosure that must be provided to the consumer at least 3 business days before consummation. What transactions does TRID cover? TRID applies to most closed-end consumer credit transactions secured by real property. It does not apply to a HELOCs, a reverse mortgages, or a chattel dwelling loans, such as loans secured by a mobile home or by a dwelling that is not attached to real property, that is, land. Consistent with the current rules under TILA, the rule also does not apply to loans made by a person or an entity that makes 5 or fewer mortgages in a calendar year. However, certain types of loans that are currently subject to TILA but not RESPO are subject to TRID's requirements, including a construction-only loans and a loan secured by vacant land or by 25 or more acres. What are the TRID record retention requirements? The creditor must retain copies of the closing disclosure for 5 years after consummation. For evidence of compliance with the integrated disclosure provisions, www.google.com, www.yahoo.com, www.realtor.com, www.homeagain.com, www.realestate.com, www.zillow.com. California_E_principles_10E_book.in 256 the 23rd of May 2017 2:30 and 28 seconds p.m. Unit 8 Financing Real Estate 257 of Regulation Z, including the loan estimate. Creditors must maintain records for 3 years after consummation of the transaction. What are the general requirements for the loan estimate? For closed-end credit transactions secured by real property, other than reverse mortgages, the creditor must provide the consumer with good faith estimates of credit costs and transaction terms on a new form called the loan estimate. See Figure 8.9. This form integrates and replaces the existing good faith estimate (GFE) and the initial truth in lending disclosure for these transactions. The creditor is generally required to provide the loan estimate within 3 business days of the receipt of the consumer's loan application. The loan estimate must also be delivered or placed in the mail no later than the 7th business day before consummation of the transaction. The consumer may modify or waive the 7 business day waiting period after receiving the loan estimate if the consumer has a bona fide personal financial emergency that necessitates consummating the credit transaction before the end of the waiting period. What are the general requirements for the closing disclosure? For loans that require a loan estimate and that proceed to closing, creditors must provide a new final disclosure reflecting the actual terms of the transaction called the closing disclosure. The form integrates and replaces the existing settlement statement, HUD-1, and the final truth in lending disclosure for these transactions. The creditor is generally required to ensure that the consumer receives the closing disclosure no later than 3 business days before consummation of the loan. The closing disclosure form is described in detail in Unit 10. New 3-day waiting period. If the creditor provides a corrected disclosure, it may also be required to provide the consumer with an additional 3 business day waiting period before consummation. May a consumer waive the 3 business day waiting period? Yes. Like the 7 business day waiting period after receiving the loan estimate, consumers may waive or modify the 3 business day waiting period when the extension of credit is needed to meet a bona fide personal financial emergency. The consumer has received the closing disclosure and the consumer gives the creditor a dated written statement that describes the emergency, specifically modifies or waives the waiting period, and bears the signature of all consumers who are primarily liable on the legal obligation. A business day is any day except Sundays and federal holidays. Some state-chartered lenders also recognize state holidays. 258. Figure 8.9. Loan estimate. 261. The creditor is prohibited from providing the consumer with a pre-printed waiver form. When must the settlement agent provide the closing disclosure to the seller? The settlement agent must provide the seller its copy of the closing disclosure no later than the day of consummation. When must creditors deliver the home loan toolkit? Creditors must provide a copy of your home loan toolkit, a step-by-step guide to consumers who apply for a consumer credit transaction secured by real property. except in certain circumstances. See below. This booklet is published by the Consumer Finance Protection Bureau to help consumers applying for FedER-related mortgage loans understand real estate transactions. The creditor need not provide the booklet if the consumer is applying for a real property secured consumer credit transaction that does not have the purpose of purchasing a 1 to 4 family residential property, for example, refinancing, a closed-end loan secured by a subordinate lien, or a reverse mortgage. Creditors must deliver the booklet or place it in the mail no later than 3 business days after receiving the consumer's loan application. When 2 or more persons apply together for a loan, the creditor may provide a copy of the booklet to just one of them. Does TRID require any other new disclosures? In addition to the disclosures discussed above, TRID also changes some other post-consummation disclosures provided to consumers by creditors and servicers, the escrow closing notice and mortgage servicing transfer and partial payment notices. For loans subject to the escrow closing notice requirement, the creditor or servicer must provide consumers with a notice no later than 3 business days before the consumer's escrow account is cancelled. The escrow closing notice must be provided before cancelling an escrow account to any consumers for whom an escrow account was established in connection with a closed-end consumer credit transaction secured by a first lien on real property or a dwelling. Except for reverse mortgages. Impound accounts. The lender may require that an impound account be established for the benefit of the borrower, to accumulate reserves for future occurring costs, such as property taxes and hazard insurance. The borrower's mortgage payments will be increased to cover contributions to the impound account, which is held in trust for the borrower's benefit by the lender. California_E_principles_10E_book.in 261 the 23rd of May 2017 2:30 and 30 seconds p.m. 262 California Real Estate Principles 10th edition. An impound account may be required by a lender in California as a condition of loan approval on a loan secured by a single-family, owner-occupied dwelling, only when the loan amount is 90% or more of property value. A combined loan amounts exceed 80% of property value. It is required by a state or federal regulatory authority. The loan is made, guaranteed, or insured by a state or federal governmental lending or insuring agency, or the borrower has failed to pay 2 consecutive tax installments on their property before the delinquency date for the payments. Civil Code Section 2954. If both lender and borrower agree, an impound account can be established in other circumstances as well, but cannot be made a condition of loan approval. Homeowners who make use of an impound account should verify that amounts withheld are not excessive and also that property tax and other payments are made on time to avoid late payment penalties. The lender is not allowed to charge a fee for preparation or distribution of RESPA or TLED documents. The lender is also prohibited from paying a fee, kickback, rebate, or other thing of value to any person who does not provide loan services. The same prohibitions also apply to title and escrow companies. Examples of loan services that may be compensated include counseling the borrower, comparing borrower housing needs with available mortgage loans, and keying information into a computerized loan origination system. Consumer Communications. The Consumer Financial Protection Bureau, CFPB, created by the Dodd-Frank Act, has issued new mortgage disclosure rules that took effect January 10, 2014. A consumer information pamphlet, found at http://files.consumerfinance.gov/f/201301_CFPB_mortgage servicing rules_what it means for consumers.pdf, must be provided to the borrower. The pamphlet explains the information that the lender must provide to the borrower and also explains how the borrower can initiate a complaint if the lender is not following the rules. The lender must provide billing information in writing. Give the borrower 2 months warning if an adjustable rate mortgage will have a rate change. Promptly credit the borrower's payments. Respond quickly when the borrower asks about paying off the loan. Not charge for insurance the borrower doesn't need, or overcharge for insurance the lender provides if the borrower fails to do so. Force-placed insurance. A kickback is an illegal fee paid by a non-licensee, such as a loan officer, to a salesperson or broker. http://files.consumerfinance.gov/f/201301_CFPB_mortgage servicing rules _what it means for consumers.pdf California_e_principles_10e_book.in 262 the 23rd of May 2017 2:30 and 30 seconds p.m. Unit 8 Financing Real Estate 263A Quickly resolve complaints, generally within 30 to 45 business days, and share information. A. Contact the borrower to help if the borrower is having trouble making payments, and work with the borrower before starting or continuing foreclosure, and A. Allow the borrower to seek review of the decision about a loan workout request. Other loan considerations. Loan assumptions and subject to when property is sold or transferred, the existing loan may be paid off by the seller or assumed by the new owner, if the loan agreement allows. Another possibility is for the property to be taken subject to the loan, if the loan agreement allows. In a loan assumption, the new borrower is substituted for the old borrower, the seller, releasing the seller from further obligation under the note. If a property is taken subject to the note, the seller will technically still be liable for the remaining indebtedness. If the buyer defaults, the lender can look to the seller, the former owner, for payment. Taking possession subject to an existing loan benefits the buyer, who cannot be held liable for any deficiency judgment that might stem from a default on the loan. Loan costs are usually lower than what would be paid to obtain a new loan. Loan assignment. The Helping Families Save Their Homes Act amended TILA in 2009 by requiring that consumers be notified of the sale or transfer of their mortgage loans. The party acquiring the loan, whether a purchaser or assignee, must provide the required disclosures no later than 30 days after the date on which the loan was acquired. The regularly updated Consumer Compliance Handbook for Regulations Ed can be found at www.federalreserve.gov/board/submanual/cch/til.pdf Acceleration and due on sale clause. Most mortgages and trust deeds contain a provision that allows the lender to declare the remaining indebtedness due and payable on the happening of certain conditions. The loan can be called. The lender can demand full payment if the borrower defaults by A. missing a payment, A. failing to pay taxes, A. committing waste by failing to maintain the property that is used for security, or A. using the property for an illegal purpose. www.federalreserve.gov/board/submanual/cch/til.pdf California_e_principles_10e_book.in 263 the 23rd of May 2017 2:30 and 30 seconds p.m. 264 California Real Estate Principles 10th edition. An acceleration clause may also be put into effect when the borrower relinquishes possession of the secured property by sale or transfer, preventing an assumption by a new owner. Use of such an alienation or due on sale clause has been the subject of much case law and legislation. At present, due on sale clauses are enforceable. Generally, loan agreements provide that fixed-rate mortgage loans are not assumable, but variable interest rate loans, which allow an increase of income to lenders if market conditions warrant, are assumable. Construction lending. The length and expense of the housing development process has resulted in several types or specialized loans. A construction loan, also called an interim loan, is one made to finance building construction or other improvements to land. Loan funds are usually made available to the builder in increments as the construction progresses. The builder may arrange for permanent financing for the property buyer in the form of a takeout loan for the buyer. The proceeds of the takeout loan are used to pay off the builder's construction loan, to ensure that funds are available for prospective purchasers of the completed properties. A mortgage banker may make a standby commitment to a builder, agreeing to make mortgage loans at a stated price for a future time. The builder pays a standby fee for this privilege. The loan application. The Uniform Residential Loan Application, Form 1003, typically is used to qualify a prospective borrower purchasing a single-family residence. Form 1003 was prepared by Freddie Mac, formerly the Federal Home Loan Mortgage Corporation, or FHLMC, and Fannie Mae, FNMA, formerly the Federal National Mortgage Association, which are discussed in the next unit. Use of a carefully drafted form helps ensure that the Federal Equal Credit Opportunity Act is not violated. That act prohibits discrimination based on age, sex, race, color, marital status, religion, or national origin. All applicants must be considered in light of their income, the stability of the source of that income, total assets and liabilities, and their credit rating. The three major credit reporting agencies are Equifax, Experian, and TransUnion. Several companies have created methods of analyzing a borrower's credit reports to produce a credit score. One of these companies is Fair Isaac Corporation, headquartered in San Rafael, California, which produces a credit rating known as the FICO score. A borrower whose FICO score is in the highest range will be able to obtain financing at a lower interest rate than someone who has a FICO score in a lower range. Someone with a FICO score in the range of 760-850 is considered an excellent credit risk. An individual with a score below 620 is considered a very poor risk and will pay a much higher interest rate, assuming a loan can be obtained. More information about credit scoring, and how a credit score can be improved, can be found at www.mifago.com. If a loan is rejected, the Federal Fair Credit Reporting Act, FCRA, and state law require that the lender provide a statement to the loan applicant within 30 days. A copy of the Uniform Residential Loan Application can be downloaded from www.findme.com, www.equifax.com, www.experian.com, www.transunion.com, www.mifago.com. California_principles_10e_book.in 264 the 23rd of May 2017 2:30 and 30 seconds p.m. Unit 8 Financing Real Estate 265 detailing the reasons for the refusal. The loan applicant also has the right to a free copy of any credit report that was considered in the loan application process. California Civil Code Section 1785 provides credit reporting protections for victims of identity theft. If a victim of identity theft provides a police report or valid DMV investigative report of the violation to a consumer credit reporting agency, the victim is entitled to receive, free of charge, up to 12 copies of her credit file during a consecutive 12-month period, not to exceed 1 copy per month. The Federal Fair and Accurate Credit Transactions Act of 2003, FCTA, amended FCRA by creating a procedure for victims of identity theft to include a fraud alert on their consumer credit reports. Numerous provisions of FCTA apply to lenders, insurers, landlords, and others. The text of the law is available at www.ftc.gov/os/statutes/031224fcra.pdf. The loan application usually follows an interview with a loan officer of the lending institution. The interview is useful in explaining the loan procedure and initially qualifying the loan applicant. The next step is the loan officer's analysis, which includes the property being considered for purchase. An appraisal is made to ensure that the property will provide good security for the amount borrowed. After the loan is approved, the necessary paperwork and funding are usually handled through an escrow agent, who makes sure that all parties have fulfilled their obligations before the transaction is closed. There is a detailed description of the obligations of buyer, seller, and escrow agent in Unit 10. California Restrictions on Predatory Lending and Products. California's covered loan law, found in Financial Code Sections 4970 4979.8, applies to loans that do not exceed the maximum conforming limit established by Fannie Mae for owner-occupied 1 to 4 unit properties. The law restricts fees and points that may be charged to and paid by a borrower to no greater than 6% of the total loan amount, restricts prepayment penalties to no greater a term than 36 months, places limitations on loans that allow negative amortization, and includes additional restrictions against certain specific abusive lending practices, including prohibiting the origination for refinancing of any loan that fails to offer any benefit to the borrower. Effective January 1, 2010, 3 new restrictions designed to protect California home buyers and borrowers from predatory lending practices were implemented. These provisions include the following: A mortgage brokers shall not steer, counsel, or direct a borrower to accept a loan at a higher cost than that for which the borrower could qualify based upon the loan programs regularly available to the broker. A mortgage broker who provides mortgage brokerage services for a borrower shall not receive compensation, including a yield spread premium, fee, commission, or any other compensation, for arranging a higher-priced mortgage loan with a prepayment penalty that exceeds the compensation that the mortgage broker would otherwise receive for arranging the higher-priced mortgage loan without a prepayment penalty. When providing mortgage brokerage services for a borrower, a mortgage broker shall receive the same compensation for providing those services whether paid by the lender, borrower, or a third party. No licensed person shall recommend or encourage default on an existing loan or other debt prior to and in connection with the closing or planned closing of a higher-priced mortgage loan that refinances all or any portion of the existing loan or debt. Negative amortization loans are banned for higher-priced mortgage loans, HPML, which are made to borrowers who do not qualify financially for other loans. Prepayment penalties are limited to no more than 2% of the loan balance. State regulators are allowed to enforce federal lending laws. Combating mortgage fraud. Under its mandate from FICTA, the FTC has instituted an anti-fraud regulation, called the Red Flags Rule, that requires creditors and financial institutions to implement programs to identify, detect, and respond to the warning signs that could indicate identity theft. The financial regulatory agencies, including the FTC, developed the rule, which took effect on March 1, 2011. More information can be found at www.ftc.gov/redflagsrule. The Fraud Enforcement and Recovery Act of 2009 provides federal authorities with expanded legal powers against individuals and mortgage operations that previously have only been overseen at the state or local levels. The law has created a Financial Crisis Inquiry Commission with broad powers to investigate such topics as the subprime boom, Wall Street influence, and bank failures. The law devotes $650 million over 2 years to hire fraud prosecutors and investigators at the Justice Department, $140 million to increase the number of FBI officials for the agency's mortgage fraud task forces, $100 million to expand the staff of the U.S. www.ftc.gov/redflagsrule. California_E_principles_10E_book.in 266 the 23rd of May 2017 2:30 and 30 seconds p.m. Unit 8 Financing Real Estate 267 Attorney's Office, and $80 million to expand the Justice Department's criminal, civil, and tax divisions. HUD, in partnership with the Loan Modification Scam Prevention Network, a national coalition of public and private enterprises, has created a website, www.preventloanscams.org, to which homeowners can report questionable practices. The site is designed to help establish a national complaint database for federal, state, and local governments. Information available at the site includes a state-by-state breakdown of resources available to consumers.
Perfect.